So let's talk about real estate. We've been wrestling with real estate. China's been wrestling with real estate. The way I see it is you have 2 points of inventory, new build and then old build or old supply. Old supply, they're struggling to move that. But we are seeing an uptick in purchases of new homes. New homes is actually improving year on year, more than 20 to 30% in some of the major cities and double digits, low double digits in tier 3 cities. What's your take? We talked a little bit about different tactics that both private and public sector can take on absorbing some of the supply, the oversupply that's happening, especially in the commercial sector. Yeah, what are your thoughts there?
Yeah, good question. Chinese investor and Chinese people like real estate, period. So this is an asset class that would not go away. I think it's deep in my father's blood, if you like. So real estate or property is such an important asset class in China, no matter the ups and downs and bubble. And to be honest, Alvin, I care more about how I make money or strike the uncorrelated or even more better, counter-cyclical money-making alpha opportunity in the real estate sector rather than the policy, the bad loan, or, the demand supply. Because already there is a big pool of real estate in China. And that's why this alpha, I call it historical alpha or the past alpha, is because of the asset bubble. It's because of the high growth history of the China economy in the last 10 years. There is a lot of hotel, residential, and also commercial real estate being built. Those are the legacy issue. But those create alpha for the strategy that which I'll explain you right now. So that's why the third bucket, I call it historical alpha. So we have this alpha because of the boom and bust cycle that we are making opportunity for this. The first one, I'll give you an example, is the hotel, which is also a project that we work already and making high teens type of IRR. Historically, there is some 4-star hotel being built in China by some of the real estate developer. When the time is good, they want to build hotel in tier 1, tier 2, tier 3 cities. Some of the new hotel, they become insolvent. They become collateral by the bank. And then the bank, they don't know what to do. They sell it at a discount last year, before, and even right now. So investor, they can buy those hotel at 30%, 40% discount to their current price, which is sort of distressed. But there is no point that you buy a hotel and without able to rent it out. So what is interesting is only for the tier 1 city like Shanghai and Beijing, is we are replicating what the US market cycle has been doing, a value add. So we bought the hotel or some other asset manager bought the hotel, refurbish into service apartment, and then rent it out to the middle class income people or some of the second generation people with rich parents who try to work in Shanghai, and then they're able to pay a little premium on those service apartments. So those are the structural opportunity that, for example, you put on a pet-friendly, service apartment. The occupancy rate of this type of service apartment, for example, the one that we are operating, is close to 100%. So again, seeing is believing. If you are having a good quality, the right price, you're able to convert distressed asset into this unique alpha opportunity, and it's inflation sensitive. And to our client, they are happy about it as well because they see they do not want to own a residential house anymore because they also see oversupply of residential house. But they don't mind own a service apartment that with flexible terms and is highly inflation sensitive, and they don't have to worry about lending out operating because they are only a part of a business owner or owner of that service apartment, if you like. So this is the first alpha opportunity or counter-cyclical opportunity in the real estate, in the hotel residential side. And I can share one on the commercial side as well.
Wow. So are they selling the hotel buildings outright, or are they partnering with investors for a rebuild? Because there's two things here. I think the hotel itself already has infrastructure well built in place, might be some renovation work, but would you need to rezone it? I guess you'd need to get a license or rezone it for residential, right?
Good point. So that's filtering. Again, this is a really specialized expertise or area. The best source of the project is from the lawyers and to some extent from the banks who want to strip out some of the hotel. So the hotel are owned by the busted, real estate developer, big and small before. Because historically, even some of the smaller real estate developer, they bought really prime location land in Shanghai or Beijing, and then they built a 4-star hotel with like 200 rooms or 150 rooms. But now they're insolvent. So those assets are to the bank. And then the bank, they don't know how to do it. They just sell it out. And then the rebuilding is done by the asset manager. And the operator, to be honest, is also very interesting by some of the listed operator in China that they operate a series of service apartment hotel chains. So as an investor, you don't have to worry about the operation team and stuff like that because they have a database leasing out those service apartments.
Right. And when the investor comes in and buys it from the bank, essentially it's almost like auction. They're getting a discount. Can they still get financing on top of that?
Yes, but again, I think the bank is quite hesitant in lending out the financing to the real estate related projects. So the trick is there is 2 stages. The first stages is the equity component would be higher. The lending part is smaller, but once the hotel is up and running for 1 year, and then with operating cash flow, then you can refinance.
Restructure it and refinance. Yeah.
Leverage. And then the bank is happy to lend it out in a really attractive rate because the interest rate or the risk-free rate in China is going down as well. So 1 year later, you can refinance at a very attractive rate.
That's pretty interesting. On the commercial side, when I think about the glut and just sort of like the oversupply of commercial property, I'm reminded of like Japan in the mid 2000s, right? Like you could get back in the day, you could be in Shibuya and get a medical building for a cap rate of like 16%. It was like incredible. We're not there yet with China, but in tier 1 cities, how are private investors taking advantage of the oversupply there?
Very good point, Alvin. I think it's more than a financial analysis, cap rate type of profile. Because at the end of the day, the biggest risk to me on real asset is actually you're owning a hard asset with less liquid stuff and you are partnering with the beta part of the component. For example, if the whole sector coming down, you are suffering, your value, would go down. No matter how good a cap rate is there, there's no put, if you like, there's no downside protection. You become a value investor, all of a sudden. The beauty of the commercial part is why I call it historical alpha is because of the oversupply of the grade A office building in China, in particular the tier 1 and tier 2 city. In Shanghai, we are talking about 25 to 30% vacancy rate of the grade A office in Shanghai. And I think that number is understated. So now the opportunity for this is as an operator or asset manager to negotiate with the landlord, with the office building owner. For example, a few projects that we have been doing and we're actually inspired, mimicking some of the US and European group, what they're doing historically is, for example, we go to a big landlord, they have the whole office building, but they only rent out half of it. Prime location, they have a problem in lending it out and they don't want to put money or they don't want to lower the rent, they don't want to put money to do the installation.
Renovations or installations, Yeah.
And then also the tenants, when they move in, they feel like, oh, I have to do the decoration, renovation, and everything. There is a hard commitment on the tenant as well. So that creates a vacuum opportunity as a fund manager and operator. For example, some of the cases, we go to the landlord and say, how about we rent the whole floor for 10 years? Partnership. I won't use the word rent. For the first 2 years, it's rental free. So there is they don't charge a rent for this business. And then the other 8 years is sharing. 60%, 40%, depends on the negotiation and things. But as an operator and as an asset manager, we either raise a fund or we put in our own capital to do the renovation or the decoration.
Wow.
So it's in-house. So we decorate the whole floor into different units. Some form like a business center. Some form would be a different unit that even you walk in that floor, you didn't know this is one operator. But we find the tenants coming in and then we operate, we collect the rent, etc. So to the landlord, it's hassle fee. Instead of they letting the whole half of their building empty, there is someone that taking care of them. So to them, it's incremental.
It's almost like tenant financing in a way, right? Because the tenant is financing the renovation work that otherwise, quite frankly, would be a capex on expense on the landlord.
The payout is really long tail and the payout is really counter-cyclical because you are locking in 10 years rent in a grade A office in Shanghai, let's say 60-40. If the landlord get 60, you get 40%. And then in 4, 5, 6 years, if inflation coming back, economic coming back, the payout is better. I don't see a tenants or rent financing would be correlated to the rent, 5, 6 years ago. And the down payment is really small is because the down payment is two things. One is you have to put in the money to decorate an empty floor. And then the second is to find an operation team to bring the talent in and help serve them. So that is the payoff. So again, it's asymmetric payoff profile. The worst case scenario is you lose your money in decorating the floor, period.
When you explained this, I was thinking like WeWorks, right? Kind of like the WeWorks adoption model was very similar. You get these long leases. WeWorks comes in and completely spends millions on renovations and common areas and the whole dynamic of the community space, something that very few landlords, quite frankly, would be willing to do. But the difference here is that you have this Rev-Share agreement between the landlords, right, and the investor.
That's why it's a historical alpha. If you're doing this in China 5 years ago, the landlord won't even negotiate that terms with you. They need you, for example, WeWork or other service provider, to underwrite, to sign a 5 years lease with them. So the investor or the operator is taking the downside risk if they cannot find talent, if the rental go down. But now it's a partnership model. That's why the downside is limited. So I would suggest it's a different business opportunity and model than WeWork, which they underwrite the whole rent and then they let it out to somewhere else. The risk reward is totally different.
I love it. This is fascinating. I mean, you see, this is the on the ground, as you say, on the ground alpha that most investors really don't get to think about. And just for examples like this, what type of investors? Are there foreign investors participating in this? Because I still feel like it's early days for US investors to come in, especially on the private equity side. Where's the capital coming from?
To be honest, for the real estate property related strategy, I think most of the, at least for growth clients, is domestic institutions and domestic big family office, which they realize the value. Most of them didn't get burned by the real estate cycle. So that they have the dry bullet, and they also realize real estate is an important or inflation sensitive asset class, or stable cash flow is an important element to the asset allocation. So mostly domestic. But global investor, I'm seeing also some transactions that they are coming in, but the angle is quite different. In particular from the Middle East, they come in, they buy a 5-star hotel, and then they want to own it for 10 years. So I think it's a different angle, and they're not just looking for alpha, they're more looking for bottom fishing, beta, or China component for their longer term portfolio. But this type, I think, is very unique alpha. So I would say investors seeing is believing. Once they travel, they look at it, they realize it's a call option return profile for them to participate in long-term China growth.
I love it. Oh, okay, that's fantastic. So look, let's wrap this up. William, one last question. You've already given, clearly you're focusing on these 3 areas moving forward. You also run kind of like a fund of funds as well. You're working on an EAM project as well. Yeah, so if you were to pick one thing that you're focusing on for the next 6 months, what would it be?
Well, I think trying to expose the opportunity of China as much as possible.
Yeah.
Because I think it's about competition. The more people realize the opportunity, the more people will participate in the market and it squeeze out the talent. Because that's why I don't mind sharing part of the secret sauce. Because I think in our industry, we should upgrade and compete ourselves and let everyone know about the opportunity. So my message is seeing is believing. I'm focusing on finding the talents, the alpha opportunity for domestic and global investor, and also for the EM and the private bankers. Because once they realize the opportunity in the China market, maybe for their global asset allocation, they will also allocate back part to the China market. So the ultimate mission for me is kind of like yourself, Alvin, is to introduce or to liberalize or democratization of an alpha opportunity in China for the global investor. Because with that, it will make the market more efficient, and along the way the investor can make some money, which is a good thing as well.
Excellent. Well, with that, thank you so much, William. It's always a pleasure sitting down and chatting with you, and yeah, we'll see you on the next one.
Thank you so much. Have a good day.